Good afternoon. It's nice to see everyone in person for the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE and transparency. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting. We'll continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right, 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think a 1 month. 1 month is not no. 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But again, our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't. We can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand, and that you can see that in the labor market where demand is substantially in excess of supply of workers, and you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand there. More than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really, you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So, the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates. So higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity, we take it as a given. We don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Okay, Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring in?
All right, you're watching live video of Fed Chair Jerome Powell's news conference following the FOMC's decision to raise interest rates by 50 basis points as widely expected. Powell saying more 0.5% rate increases are on the table in future meetings. This is all about Bitcoin, a show dedicated to all things questions and markets related to Bitcoin, little b for the currency, and Bitcoin, big B for the network. A collective journey to understand, apply, and use this innovation, all Bitcoin, all the time. I'm your host, Christine Lee. Let's have a live look at Bitcoin right now. The CoinDesk Bitcoin price XVX index right now at $39,585. Bitcoin is rising about 5% over the past 24 hours. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. Taking a look at some of our top stories, crypto funds suffered a fourth straight week of outflows amid the stagnant Bitcoin market. Overall, digital assets funds had $120 million in net outflows last week. Bitcoin-focused funds suffered the most, losing $132 million last week, the highest so far this year. Since the start of April, Bitcoin funds have suffered a cumulative $310 million of redemptions, though year to date, the funds are still net inflow positive by $120 million.
By Crypto.com, the world's fastest growing crypto app.
Bitcoin appears to be in the final stage of a bear market characterized by undervaluation and submission, according to a popular technical analysis indicator. Bitcoin's Meyer multiple, the ratio of BTC's price to the 200-day simple moving average, is just shy of 0.8, as shown by the green trace over there. And in other words, BTC is just trading at a nearly 20% discount to its 200-day simple moving average. Such a price structure has been relatively rare in Bitcoin's 11-year history, making the reading on the Meyer multiple a point of undervaluation. Nevertheless, CoinDesk's Omkar Gaboli saying that doesn't necessarily imply a quick bullish shift in the momentum thanks to expectations of a hawkish Fed. However, we could see a minor relief rally now that the Fed has matched the widely expected and priced in 50 basis point rate hike. All right, joining us now to discuss BTC price and more is CoinDesk Markets reporter Damanick Dantes in New York. Hi there, Damanick. So we just came out of that Fed news conference. Just want to get your overall takeaways.
Yeah, we're seeing the market reacting pretty positively. Right around the Fed hike, there was a dip, and that was off the session highs around 39K. We were rising towards that level prior to the rate hike, and then you kind of got the news settled in, and you saw the sort of reaction there. The initial negative reaction was because of the rate hike, right? That's usually negative for speculative assets. However, the commentary after the hike by Chair Powell was pretty positive. He stated multiple times that the economy can handle a rate hike. So that shows that there was some confidence in the economic strength. You can see in the rates movement prior to that, there was expectations for slower growth, and there were signals of recession. So I think that was initially spooking markets, but the vote of confidence from the economy standpoint, I think, is what's triggering some of the bullish activity right now.
All right. How long do you see that lasting? I mean, going forward, he said that there were more 50 basis point rate hikes on the table. What impact do you think that might have in the Bitcoin market going forward?
Yeah, so the expectation for slower growth in light of higher rates is kind of now being tampered a bit or eased a bit. So I think that allows the market some room to sort of recover a bit. And we're entering a seasonally strong period, so that can lower the selling pressure at the very least. Right now, I think heading up to around 40 to 43K is that resistance range. So we'll see if buyers can withhandle that into the Asia trading day.
All right, and we're entering the month of May, so wondering what is the seasonal trend for Bitcoin? It's not so much sell in May, go away as the traditional market expression goes.
Yeah, so the sell in May is actually taking profit, kind of. So you take profit in May, you take advantage of those short-term gains, and then you kind of sit out, especially when you're in the mid sort of cycle range. Right now we're in the presidential cycle, so you have like midterms coming up, and typically equities don't perform too well between May and September. And then you get the Q4 back half, which is pretty strong. So this chart just shows average historical returns per month for Bitcoin over the past 9 years. Up above is those average returns per month, and then below is a percentage of times that Bitcoin produced a positive return in those given months. So right now your odds are pretty high. We're 75% of the time closing positive with about a 17% price rise. Now you have to put that within the context of the wide trading range that we have between about 30K and 46K. So that gives you about 20% swings up to 20% swings down, which have been the norm over the course of this year. So a 17% price rise can just be at the top of the range, and that'll give you some time to sell in May and then go away.
Mm-hmm. It's also interesting in this chart below that, basically every month Bitcoin on average goes up every year. But it also shows that April is usually up, but that ended up being a down month. So it's not always the most accurate indicator.
It's 50-50. And returns do not, and historical returns do not guarantee future returns.
Yep. So what is the trend for long-term holders right now? Are they finally selling? Is there any capitulation, or how many are still in profit?
Yeah, about 70% of the market is still in profit according to Glassnode data. And typically when you get to 40 to 50% of the market in profit, that signals like a sort of cycle low. So we're not there yet. Over the past 3 months, the long-term holders have been taking some profit, and that's evidenced by the decline in their cost basis. And you see that decline heading towards a 13K level. And the price at which you're selling or sort of panic selling was around 38K. So that indicates zero profit. So there is some sort of capitulation going on, but we're not at max capitulation, which will define a cycle low just yet.
Mm-hmm. How is BTC performing compared to the alts?
Compared to the alts, it's holding pretty strong over the past few months. So year to date, the Bitcoin dominance ratio is still pretty elevated, above that 40% level, still higher than what we saw in 2018, which was a crypto bear market. So there's still some room to increase. Month to date, over the past few days, the Bitcoin dominance ratio has declined a bit. So alts have been leading, coming in and out of favor, like AVAX and a few other tokens, but those have been just speculative and risk on and risk off in nature. So you really want to follow the trend. And right now, there's still that sort of disregard for risk right now.
All right. Well, Damanick, thank you for the analysis. Appreciate you coming on the show as always. That's CoinDesk markets reporter Damanick Dantes. All right, coming up, Panama legalizing Bitcoin for payments. We'll discuss with Panamanian Congressman Gabriel Silva. Welcome back. Marathon Digital, one of the largest publicly traded Bitcoin miners, saying today they are cautiously optimistic about meeting early 2023 hash rate guidance as delays continue. The firm mined 299 Bitcoins in April, a near 31% dip from the previous month due to weather and maintenance issues. Meanwhile, the Council of Europe's Moneyval Committee is calling on European states to clamp down on crypto-enabled money laundering. Moneyval, which monitors smaller European states' compliance with dirty money norms, warn that of market manipulation challenges posed by decentralized finance, privacy coins, and major cryptocurrencies. And finally, Panama has not made Bitcoin legal tender, but you can use Bitcoin for payments now that the Central American country has passed a crypto-friendly bill that also makes cryptocurrencies exempt from capital gains tax. Joining us now to discuss is the sponsor of the newly passed legislation, National Assembly of Panama Congressman Gabriel Silva. Welcome, Congressman, to the show.
Thank you for the invitation. Glad to share with you and your audience a little bit about this important proposal for Panama's present and future.
Absolutely. So originally you had intended to actually make Bitcoin legal tender. So explain to us this pivot.
Yes, it's a little bit different from what we saw in El Salvador, which is a very close country from Panama. In El Salvador, we saw that the Congress and the president signed and approved a legislation that establishes Bitcoin as a legal tender. This basically means that the use of Bitcoin is permitted and it's also mandatory. If you go to a place and you want to use Bitcoin to buy something, the shop has to allow that exchange. We wanted to do this in Panama. We wanted to make it a legal tender and establish Bitcoin as a legal tender. However, we can't do that because our constitution, since it was created over 100 years ago, it establishes that in Panama, we can't have a legal tender. That means there's no mandatory coin in Panama. It's open. You can come to Panama and use US dollars, yuans, euro, whatever. Therefore, we couldn't do that in the law proposal because it would have been unconstitutional. Nevertheless, what we did was to create the possibility, the legal certainty, the legal clarity that in Panama, you could use Bitcoin as well as any other cryptocurrency to make payments, to make exchanges as a means of payment. Panama was one of the few countries in the world that didn't have any public policies, law, resolution that established a legislation about this, and was important for Panama to take this step. Because what we're seeing in the world is that we have some countries like China and Russia that are very restrictive in the use of cryptocurrencies. Nevertheless, we have other countries that are very permissive, like the United States, Brazil, Chile, Argentina, El Salvador. And Panama was in that gray zone of countries that hadn't legislated or said anything about it. So what we're doing, one of the things that we're doing with these projects is provide that legal certainty, the regulatory and fiscal certainty for the use of crypto assets in Panama. And as you well said, there are many benefits in Panama for handling cryptocurrencies and investing in cryptocurrencies and crypto assets in Panama, because the taxes are pretty low in comparison to the rest of the region, 0% capital gain taxes. So that's very beneficial for the country as well.
Well, maybe you can elaborate on some of the benefits of being able to pay for things with cryptocurrencies, because, there's also a lot of volatility in cryptocurrencies. So how much of a concern is that a factor?
Yes, I think that in Panama, in the particular case of Panama, this legislation is very important because, and I talked with many members of parliament and explained, some of them may have thought that, cryptocurrencies are only for geeks that are behind the computer working all days with computer, or that are for very rich people. But this project, this proposal, cryptocurrencies have a very important social impact that sometimes it's not discussed in politics or in parliament or in different forums. In Panama, over 50% of the population don't have a bank account. And that is very problematic for an individual, an average person, a middle-class person, lower-class, economically speaking, because it's very difficult for them to participate in the economy of the 21st century. Giving them the possibility and the legal certainty and the legal framework so that cryptocurrencies, Bitcoin and others, can be used in Panama in a safe way, helps them get involved with the economy of the 21st century. It helps them receive payments in a more faster and easier way. Because as I mentioned, today, almost half of the population don't have a bank account. So I usually gave the example, very simple for other congressmen and congresswomen to understand. If we have a Panamanian that's in the mountains of Darien, which is a very remote place in Panama, and he's selling mangoes, a very common fruit here in Panama. And then he finds a tourist that is from Japan. And that tourist doesn't have dollars. We use dollars in Panama. And the tourist says, you know what, I'm going to pay you to your bank account. But the Panamanian doesn't have a bank account. But what we do have in Panama a lot is cell phones. We have over 6 cell phones per person in Panama. Having the legal certainty and the possibility of using cryptocurrency as a medium of payment will help that Panamanian sell its mangoes to the Japanese tourism, helping people participate in the modern economy. So I think it's important to mention, and I emphasize this a lot during the discussion in Parliament, because once again, many congressmen and congresswomen don't understand that. They're starting to understand this, but there's a very important social aspect and social impact in these types of proposals that will benefit the country on the long run.
I imagine it operates the opposite way as well. For Panamanians who are abroad, it's hard for them to interact with foreign banks because the European Union has listed, for example, Panama as a non-cooperative jurisdiction or a tax haven. So it's not so easy for Panamanians to interact with the global financial system. But we got to wrap it there, unfortunately, Congressman. But thank you so much for joining us. And congratulations on the passage of this bill. Appreciate you coming on. That was Panamanian Congressman Gabriel Silva. Right, that's it for All About Bitcoin. I'm your host, Christine Lee. We'll do it all over again tomorrow at 3 o'clock in New York. Also join us tomorrow morning at 9 a.m. for First Mover. You're watching CoinDesk TV.